Hello and good afternoon. In my case, here from Germany, Berlin, Germany, that way around. Or good morning or good evening, wherever you listen to this webinar right now. My name is Jens Klatt, and I'll be the presenter for the upcoming 45 minutes here with the topic Admiral Markets Live Trading of the US market opening. I just want to say right at the beginning here, feel free to ask all questions in the chat box. Today is in fact special day. What do I mean by special day? Well, it's a little unfortunate. Today it's Independence Day. It's a day where the liquidity in the US equity markets, the market which we will mainly focus on here, and where we planned to trade the market opening, where such a trading is of the market opening in this case is nearly impossible because there is no big volatility right now in the market, and so in fact we have to adapt this webinar a little, probably focus a little more than on theory here, and something nevertheless really interesting, because 2 days ago was a special day here in Germany. It was the 30th birthday of the DAX, and in this context, Admiral Markets offers something really special. And before we start with this and have a look here at this, I want to present to you how to nevertheless we would trade the US market opening, but also how to adopt this trading strategy then to the DAX. Why this offering is of big interest, especially for professional traders, professional thinking traders here, who are looking for more profitability in their trading. But first of all, before we start, very important, we have to have a look here at the risk disclaimer. Please make sure that, or understand, you have to understand that trading with financial instruments which are offered by Admiral Markets here, CFDs, ETFs, stocks, that these financial instruments carry a high level of risk which is not suitable for all investors due to their complex nature. And before entering into any agreement or transaction, any trade, please read the terms and conditions of the service from Admiral Markets. Consult a specialist if necessary to ensure that you understand the risks involved in trading such products here. And please also study carefully the key information documents, the so-called KID. If you're interested in getting them, contact Admiral Markets via their support, and that way you have the chance then to understand the nature, risks, costs, potential gains and losses of margin products which are offered by Admiral. So that said, why is it so important to have a look here at such a risk disclaimer? That has to do with the fact that Admiral Markets is fully FCA regulated, and therefore such a risk disclaimer, such a warning here at the beginning is necessary. Important is also why Admiral Markets, on top of it's not only because of the regulation why Admiral is a good choice as a broker, but also because Admiral offers one of the best index offerings in the CFD hemisphere here, especially in terms of the DAX. This is one of the, if not the most traded product here, with a typical spread here of 0.8 points during the main trading hours. And here the anniversary gift for the 30th birthday, which is for clients, then comes into play. This is reduced now in the month of July to 0.5. And we want to have a look at how this will affect a profitable trading strategy and make it even more profitable here, and why this really matters, and why this should be definitely considered from a professional thinking trader. Here's the regulatory background. Here are the contact details, hello@admiralmarkets.com, or also the phone number you can contact Admiral through. And that's me. And I will be the one who will now guide you through the next 45 minutes here. And what we want to do is, first of all, we want to have a look here at this 3-step intraday trading strategy for the S&P. Nevertheless, we want to adopt this as already promised here to the DAX. Then we'll have a look here at how the strategy performed yesterday Yesterday was also already a special trading day, because yesterday there was also different trading hours and short trading day, let's call it. So the market closed here at, in case of Germany, 7 p.m. German time. So this is then 5 p.m. GMT. This is the same, which is true for today. And this is especially true or important to note here when focusing on the following trading setup, because the exit of this position usually occurs at, in German time, 9:50 p.m. Central European time, so German time here. And if there is no such trading time then, and you're using, for example, a strategy which could be, by the way, automated here, well, the problem could be that you're running an expert advisor via your MT4 or MT5 platform, and then the trade is not taken out automatically, because the expert advisor is set to take out the trade at 9:50. If it's 7 once the market closes, well, no position will be taken out, and you carry the position overnight. Not sure whether this would be such a big problem right now. Somehow I personally have the feeling that the volatility will stay low. Nevertheless, we should also make sure and understand, and you can, I just recognize that this is probably right now a very difficult approach here to say something like that, because we have some big trouble right now in China, and the financial markets there are start to really see some serious headwinds, let's call it. Not only the Shanghai Composite in this case, but also the Chinese Yuan renminbi, the currency of the Chinese. This is mainly due to the fact, because currently we see not only a restrictive Federal Reserve, which is hiking rates here, but also a People's Bank of China being more, is it expensive? I think so. No, not expensive in terms of expensive, but it's like it's a more dovish approach, let's call it, a more dovish approach in the monetary policy, which is naturally then resulting in capital outflows from China into the US. But there's also those trade war fears, for example, and this is currently it's feeding itself. The circle is feeding itself, and the higher the US dollar roses compared to the Chinese yuan renminbi, the higher the chances that there will be some negative impact then on the overall US economy too, which is right now already something you can spot on the horizon. If you look, for example, at the yield of 2- and 10-year US Treasury yields here. Currently, and yesterday, the yield here, the difference between those two fell below 30 basis points. And usually such a aggressive flattening of the yield curve is a sign that short term you expect rates to rise here, thanks to the Fed, especially in the US then. But nevertheless, longer term, you don't expect the economy to continue with a strong momentum here, and that's why you see stabilization on the longer yields here, in this case 10-year yields. And this said, a higher US dollar, rising US dollar here, could then mean that the effects on the export are negative, and probably we will see some negative impacts then on the US economy too. And that way we could see or find ourselves in kind of a vicious circle here. And this means that holding overnight positions right now is probably not something you really want to find yourself in. And why do I say that? Again, because one thing of this three-step intraday trading strategy for the S&P in this case, but also for the DAX, which we will see a little later, is that we take out the position 10 minutes before the market closes and do not carry any positions overnight, to do not have this overnight risk, and to have this risk of finding ourselves on the wrong side of a gap occurring in the morning. Something to also to remind oneself, based on the fact that, for example, then back to the US economy here, the non-farm payrolls are the probably most volatile news event then at the end of the week. So currently there's not big volatility, but this could change from tomorrow onwards, especially on Friday with the non-farm payrolls, based on the last Fed decision here. But now, first of all, let's have a look here at the trading strategy and focus on these topics, the more fundamental drivers, in our weekly outlook, where we'll have the pleasure to meet again on Friday then at 12 p.m. London time, so 1 p.m. German time, for another 45 minutes. I'll give an outlook here on what not only to expect for the non-farm payrolls, but probably I'll also give some ideas on whatever data set we will be presented then around non-farm payrolls, how this could affect the markets and push it in one or the other direction. But now let's focus here on this trading strategy first. Again, purely theoretically, we won't trade it today, mainly due to the fact that we have Independence Day and we have a shorter than usual trading day. We have to define the open range. That's, by the way, also something why I can talk and talk and talk and really do not really get excited. That would be the same if we do not have Independence Day today, but today is a trading day as every other. That has to do with the fact that I have to wait from now another 5 minutes until this open range is finally defined for this approach. So we have to wait after the markets open then at 3:30 p.m. Central European time in this case for 45 minutes, and then we have a high and a high and the low, and based on that we'll have to then formulate our entry or buy stop, sell stop, depending on the advantage. The advantage, which will be identified by the exponential moving average 10 on a 50-minute time frame. It's a very simple approach. We trade above, we go long. We only trade long setups then. We trade below, we only trade the short side. And then the next thing is that we trade the break of the open range in direction of this identified advantage, placing the stop above, respectively below the range, in whichever direction we will position ourselves then. And and then we have our setup, and we can do this right now. By the way, here, this is something I've already opened. If you open the Admiral Markets MetaTrader, you can find the changed trading hours by clicking here on your news box in the MetaTrader, and then this is the first letter, or information, whatever, which appears here. You double click on it, and then a window opens, which perfectly shows the changed trading conditions. And here in this case, you can see the S&P 500 closes at 20. Why 20? Because here in this case, we're talking about Eastern European time. In my case, German time, it's 1 hour earlier. It's 7 p.m. In the case of now, you're sitting, let's say, in London, it will be 6. And if you're if you're in the time zone of GMT, then it will be 5. But all in all, it's definitely shorter than usual, 3 hours before usually the market closes. So it closes at, in our case, 7 p.m. Central European time then. The same is true also for markets like Brent, WTI. It's true for gold. Let me just see. Yeah, here, metals, spot metals, they close also at 7. For example, as you can see, the DAX, for example, stays open. So I have to look for it here. It's DAX 30. So it closes as usual. So this is the usual closing time here. Other markets like FX markets are not affected as well. It's only US related. Nevertheless, the US markets from now on are the markets where where the music plays, let's say. And if these markets do not move, we shouldn't expect the German market to move then too. And based on that, yes, obviously, we shouldn't expect too much price action now to happen. Nevertheless, from tomorrow onwards and into the weekly close with the non-farm payrolls on Friday, things could change, probably dramatically. So I really hope that it's not only that I hope that, but I have a strong feeling that non-farm payrolls this week will be more volatile than usual. So what did I do here so far is this is an explanation for yesterday, even though also here trading stopped, as you can see here, at in this case, this is also Eastern European time. So it stopped at 7 p.m. Central European time, and then reopened here at 12 Central European time. The same will be true for today. Nevertheless, from yesterday, you can already spot here that the trade would have been a profitable one. This is the open range, which we just defined here between 330 and 415. And the market obviously broke out here on the downside. Why did we take the short side? Because we traded below this blue line, which is our advantage identifier. And this is the 50-minute chart, as you can see here. And this is the exponential moving average 10. And we trade below that. If we trade below that, we take the short side. That's how the setup is defined then. And obviously, it played out really well. Nevertheless, I mean, sure, you could adapt it and just say, okay, then I take out the trade, let's say 10 minutes before, in this case, 7 p.m. German time, then 6:50. Nevertheless, this is unusual, let's say, and something which you should take in mind. And then that's why I wouldn't trade this setup then today. Now, what we can do is we can duplicate those thin lines here and do this for today. So have a look here at, have a look at these three candles here. This is the 1530 candle. So, and then we can duplicate this line again and take the low here. And purely theoretically speaking, we now would, if the market breaks below 2,716.8, if we break below this line, and based on the fact that we're trading below here, this blue line, we take the short side. So, and this is in fact it. It's, yeah, no rocket science. In fact, this is a 3-step trading strategy. Probably we can make it a 4-step trading strategy. Nevertheless, I also think we could easily extend this third point here, because it says where the stop is placed. So probably it makes sense to write down here to take profit, which is not defined in terms of a target, like you say a risk reward of 1 to 2 or something. No, it's a time take profit, which says 9:50 Central European time. We take out the trade. That's it. And yeah, so that said, it's in fact a 3-step intraday trading strategy. I will guide you through a backtest result here for the last 7.5 years around, and show that it's really a profitable approach, because many right now watching this can't really, I really strongly believe that many can't imagine that this is a profitable approach, but it is in fact. And it can be adopted again to many, many markets. And it can, for example, be adopted to the DAX, which I just did here. In fact, now I've written all this down already, and I don't let it fly in or something. Here, again, this is the 3-step intraday trading strategy. Same open range setup, in fact, only for the DAX, which is now based on the fact that it has its 30th birthday and is offered with a 0.5 point spread. That this is here something which I want to present to you and give on top on the offering from Admiral here with the reduced spread then for the next 4 weeks. So in this case, you can see that we've all obviously working with another open range. So open range in this case means nothing more than we look at a predefined time span in which the market marks a significant high and a significant low, and where you can then say, well, if the market breaks out of this range, then usually you have a strong tendency that the market in this case you're looking at here will continue to trend in direction of the breakout. And in case of the S&P 500 setup I just presented, it was 330. This is when the spot market opens and the main volume pours into the market. And we look at the first 45 minutes of trading. In case of the DAX, we start a little earlier. So the Xetra market, this is also something which is meant by main trading hours. When you can see this here on the webpage from Admiral, you can see there it's 10 Eastern European time, so 9 a.m. German time, and then 6:30, which is 5:30. And these trading hours here are in fact the so-called Xetra trading hours. These are the trading hours when the main volume is traded. It's not only that you can trade the future DAX then here at the Eurex, but also the spot market, the Xetra DAX, in which you find the 30 biggest companies based on market capitalization of Germany here. And that's also, for example, a reason why I use 9:05 instead of 9 German time, because once the this big volume pours into the market, the DAX tends to see some aggressive pushes on the up, respectively on the downside. And this is quite erratic, let's say, which means you want to avoid to be stopped into the trade here within this time span when the market presents itself in this erratic manner. And then you just wait 5 minutes until this volatility dries out, and then you place your order. And then once the breakout occurs on one or the other way and in direction of the identified advantage here, which will be done on a 5-minute time frame in this case, not a 50-minute, but a 5-minute time frame, and an exponential moving average 50, you trade the break in direction of this trend. Again, if it trades above the 50 exponential moving average on a 5-minute time frame, we go long. If it trades below, we go short. That's it. And then again, the stop will be placed above, respectively below, the high low of the range you defined here in 1. And the trade is taken out, in the case what we present here, in a slightly different manner. We take out the trade after it reaches a risk reward of 2 to 1. Or there's also another approach, which I don't want to present here because it also is potentially a little irritating, because the backtest result is based on this risk reward of 1 to 2 here. We could also work with something and aiming on a intraday trend structure, developing then based on a super trend indicator. This is also a custom indicator, which is here which has to be downloaded from an external source here, like the MQL5 community, for example, where you can get it for free and then use it in your trading. But again, we will focus here on the risk reward of 1 to 2 in the backtest then. And you can screenshot this. This is in fact an approach which is profitable. So here, there's the example on a trading day which does not end at the 7 p.m. German time, but ends here at 10. Then in this case, so this is how it looks like. There's the open range. We break out on the upside. We are obviously trading here above this blue line. That's why we are long. And then we take out the trade manually here in this region, and that's it. Okay. So now, again, is this approach for the S&P profitable? Yes, it is. Since we want to have a look at the DAX, I think it makes more sense to now look at the backtest result of the DAX, which is unfortunately not available for a period here of 7 years, even though I can say that the expected value, for example, the expectancy, but also the hit rate, open range breakout setup to have a hit rate here within which range. So usually you expect the hit rate to be something like 45 to 50%. Usually it's slightly lower than 50%. Usually it goes down to, let's say, 40, 47, 48 around. The exact same here, win rate you can find here, 47%. In fact, here, the approach for the DAX is, from a hit rate perspective, slightly below that. You can see it here. We have a winning rate in this case of 42%. So this is, again, below what you usually should expect. This, nevertheless, it still was profitable, even though the hit rate wasn't really attractive within this time span. I've back tested here the strategy, and interesting enough, by the way, is the fact that the payoff ratio was the reason why the approach nevertheless was profitable. Payoff ratio is defined as the average gain divided by the average losing trade, but something I will introduce to you right now. So I've already prepared here a question. There we go. I've already prepared a question here, which we want to answer later on. So now let's first of all, let's have a look here at the DAX open range breakout. So, and we know the hit rate of our backtest was 42%. So meaning that the loss rate is the opposite result, which is 58%. We know that the average gain was 157. We round this down, it's 157.07, but as you can see here, but this is not necessary here. And then we have the average loss, which comes down to 99. 0.70 euros. And now we know about a formula here, which is called the expected value. And the expected value is defined as the hit rate multiplied by the average gain. And then you subtract the loss rate and you multiply this with the average loss. And if you fill in those parameters here, and EV is, by the way, expected value, you get 42%, so 0.42. You multiply this with 1.57. I'm sorry. Sure, what you have to do now is the following. We have to calculate the so-called payoff ratio. We don't want to work with numbers like that, because you want to have yeah, let's call it an objective result. And that's why I want to divide here average gain through the average loss and make sure that I have a result which is not coming down to numbers which are based, in this case, on a 10,000 euro account, but I want to have the most objective result as possible. And in this case, it's 1.7 then. In this case, as you can see, it's nearly 100. You can write this up, so probably you come down to 1.58, but we go with 1.57 in this case. And from here, we subtract 58%. We multiply it with 1, and then you get, let me just calculate this, 1.57, it's 66, and we subtract 5.8. Again, the interesting thing is, if you now see those 8 cents here, this is the exact same number. Probably it's pure coincidence first, but nevertheless, I can say that usually you find the result here for this open range breakout approach. You find a result usually between 5 to 10 cents. This is usually the expected value you should expect here. And yeah, so in this moment, you can already see, okay, obviously this seems to work quite well, and it's also obviously a profitable trading approach, even though one which needs a very, let's call, mental stability. So because you will be wrong more than half of all your trades. So in this case, that means nothing more than you're trading 225 times here. That was the number of trades within this time span of nearly 1 year, a little more than that. And you were right only 94 times. And this is something which is a big problem for many traders, in fact. But this is exactly what profitability is mainly based on. Sure, you need a positive expectancy, and here the hit rate plays a very important role. If it wouldn't, or if that wasn't the case, well, you wouldn't write down hit rate here in this case. Nevertheless, profitability in trading, especially if you're a beginner, you should definitely focus on trying to find an approach which aims on making the average gain big while trying to really make the average losing trade as short as possible. And that way, profitability can be reached, even though you might have a hit rate which is, in this case, already significantly below 50%. Okay, so what does this mean here? 8 cents. What does this mean? That means nothing more than, on average, per trade, you make 8 cents per euro you risk. So first of all, that was something someone once said to me. He said, well, isn't it usual that we try to make, or try to get something out of the market which is usually higher in terms of a profit? We try to make a profit which is higher than the money we risk. Yes, this is true, and this is already achieved, since the average gain, as you can see here, is already bigger than the average loss. But what I just said was that this is the expectancy you have for each trade, and it doesn't really matter if it's a winning or losing trade. But it's the expectancy. This is the expected value you should expect to have for every trade. So since you are profitable with this approach, profitability means nothing more than you have an expected value of bigger zero here in this case. So this means nothing more than even if you're now losing, you keep on playing this game, let's say, or trading this setup, because you know every time you trade it, you make on average, per every euro you risk, you make on average 8 cents. So if you now, and this is something I want to do here in this case, let's assume the following, and let's assume we're capable of stabilizing those parameters around the hit rate, around the payoff ratio, and stabilize this expected value of 8 cents here. Now let's assume the following. Let's assume 100,000 euro, which is our trading account. 100,000 euro trading account. So if we now, as you can see here in this backtest result, have 225 trades. Okay, it's per year, 225 trades. By the way, one thing, let me just switch over here. So far, no breakout occurred, as you can see here. As you can see, there's no breakout so far, which is mainly due to the fact, again, it's independent state. There's no volatility, and I wouldn't be surprised to see the S&P not even breaking this range here. And by the way, even if it breaks, we not trade it. That's also something I'd like to emphasize here. So let's come back to this theory here. So we have 225 trades per year, and then we say we risk 1%. Risk 1% per trade, which comes down, if we look at this 100,000 euro account, to 1,000 euro risk per trade. So, okay, so what can we do now? What we can do is the following. What we can do is we can calculate what we should expect. It's a purely theoretical approach, because what now comes here up is the fact that market conditions change. And I already said the hit rate of 42% is unusually low for this approach based on my personal experience, which means that usually you should expect the market to have a higher hit rate. On the other hand, a high hit rate does not necessarily coincide with a bigger average gain on your trades. And why do I say that? Well, it's important to understand that market conditions change, and sometimes this approach probably turns a loss over a 1-year period, because, well, market conditions, in this case, to trade this approach profitably, you need to have good volatility, solid volatility, not big volatility in terms of high swings, but nevertheless, you need kind of some let's say some waves. Let's come down to surfing here. So let's assume you're a super surfer, and you really know what you're doing, and then just imagine there are no waves. I mean, you can be the best surfer in the world. If there are no waves, you can't surf. That's very simple. And this is the same, which is true for trading and trading approaches here. If you have very choppy market conditions, no real trends developing, it will be really difficult to be profitable with such a breakout trading approach, which needs at least some kind of trend structure, which is informed here. So, and this said, it's very important now to say that this is purely theoretical, even though we want to use this here to show why a reduction of the spread, even though it seems not that much, but nevertheless, why it's so important and increase your profitability to a quite attractive extent here. So now the expected value means that we are obviously making per trade, we make per trade 1,000 euros, and we multiply this with 0.08, so we make per trade 80 euro. And then we have 225 trades per year, which means we make 80 multiplied with 22.5, or 18,000, which equals, euro, which equals to 18% per year. Why? Well, we're trading a 100,000 euro trading account. So making 18,000 means we make 18,000 respectively 18% per year. So, okay, cool. The only problem here is that after running this backtest, I can say I ran this backtest here with a 1-point spread. Okay, so that means that if you run such a backtest with 1-point spread, and no commission, by the way, that's something you also have to take into account. So you might have seen brokers who are offering 1-point spread, and on top of that, giving you a commission of, I don't know, 20 cents per round turn or something like that. So that means, in fact, per CFD, that means nothing more than you're not paying 1-point spread, but we're in fact paying 1.2 per trade than when trading the DAX, for example. So in this case, let's assume that the spread here for this backtest result is 1 point. Okay, backtest, 1-point spread. And now you can see that in this case here, Admiral is offers 0.5 point spread. You can, by the way, already see that the profitability of this approach, you can easily adopt this, will be higher. It will be higher even if the spread goes back to 0.8 for Admiral from August onwards. This is something to keep in mind here. But so the thing is, now the spread is 0.5 for 1 month. This increases the overall profitability. Let's assume it's the spread for 1 year. That makes it even more significant. We could now go with the 0.8. Again, this is the spread you have to, or you can expect for a year, or in 11 of 12 cases in case of the Admiral now, and then at 0.5 for 1 month. But we don't want to overcomplicate things. I just want to make sure that you understand why the spread matters. And the spread is in fact, or the commissions in general, this is where a professional trader finds its performance, its profitability, because this is something you have to pay all the time. And this is something which doesn't change. And if it changes, well, this is happy, but or this is good for the trader, but all in all, you shouldn't expect it to change over time here. So if Admiral offers 0.5 point spread, okay, and we are looking here at 225 trades for the year, that means that the cost, 225 trades with 1 point, it means that we paid, in fact, 225 euro commission. The spread is nothing more than a commission in this case. This is okay. This is not unattractive, but I remember times when the DAX was priced with a spread of 2, sometimes 3 points. There are brokers out there who offer that, and there are still traders trading on such huge spreads. I still don't know why, but these are the traders out there you're looking for in the game of trading, because, well, let's put it that way. And when trading playing poker, for example, you consider someone who doesn't really know the rules of the game and plays unprofitably the fish in the game. And you need those fishes. You need the guys who pay the bills at the end of the month. And it's a zero-sum game. Trading is a zero-sum game, which means somebody wins, somebody loses. And you have to look that you're on the right side, which means on the side of the winners, which starts already with a profitable trading approach. Nevertheless, you really, as a professional, try to squeeze every single dime out of your trading approach to increase the overall profitability, since trading is a hard game, and those who are also profitable trying do the same at their end then, and try to squeeze out as much as possible, which then means it has to come from somewhere, and if it comes from you, you are the one who is paying their bills, and this is something you want to avoid. I think you get the point. So if you have 225 trades then with 1 point spread and 225 euro commission in this case, this means on a 100,000 euro account, it doesn't seem that much, because it's just 0.2%. Okay, and this is not that much. But have a look at it here from this perspective. We're looking at 18,000 euro here, and then things turning, because now it's the performance, and you consider this spread here, the commission you pay, you consider this to be part of your performance, which you obviously do not have at the end of the trading year in your trading account. And if you do this, you get 225 through 18,000, you get 1.25. Also, this you might say this is not much, but let's assume you're not only trading a trading approach here of 225 trades, but you have several strategies running in the DAX. You have a portfolio of strategies, and then we start to talk probably, let's say 10 strategies, all of them are making 200 trades a year. We're talking about, in this case, of 2,000 trades, and then it starts to matter, because then we're talking about 2,000 euros in commissions. And again, this is where professional traders find their performance. So it's only 1.25% here. Now, what we can easily do, and that's why this really matters, we can cut this in half if Admiral offers 0.5 point spread in this case. So you can say that Admiral's offering is, based on your yearly performance, 6. Let me just so slightly above. This is what you make more at the end of the year. Again, this is something which really starts to matter in the moment you have a very high trading frequency. Nevertheless, having 0.6% more at the end of the year in your account, this already adds up here to 18.6% per year. Okay, this is missing here in this moment, because and not only that, I mean, it's not only that 0.6 is missing. This is a very, very rough approach. It's already showing, okay, great, you just made sure that you're adding 0.6 here to your overall performance. But if you look at it from a deeper perspective, it also means that, for example, sometimes you probably got stopped out. We just do not know this, because all we do is here, we look at the results. We do not have all the trades listed. But it could be that there's a trade, probably there's 2 trades, there's probably 10 trades, where such a reduction of the spread would have resulted in not being stopped out. Or, also possible, you probably did not reach your target because the spread didn't make it possible. If you're long, you reach the target by the bid being hit. So the bid has to hit your take profit in case of a long position then to reach the take profit. That's also a possibility. So there's potentially some trades in here which probably wouldn't have stopped out, respectively, thanks to the tighter spread, reached the take profit level. Some of you will now say, well, this is details, right? All in all, the approach stays profitable, no question about it. Nevertheless, the difference can be several percent at the end of the year. So it could be that there's several, probably, I really want to say that hundreds of basis points you can make more by only looking at the spread. And again, if this wouldn't matter, professionals wouldn't look at it, and they do. I know this because I myself look at it, and this is exactly the point where this offering then is definitely something to have a deeper look in here to the DAX birthday then, and consider this to become part of your trading. At least give it a try. On top of having, for example, such a great tool here with this Supreme add-on, which Admiral is offering here, and which you can also download for free as a not only as a live client but also a demo client. Nevertheless, it expires as a demo client after 30 days. Yeah, and I just hope that this was something to inspire you, let's say, to have a deeper look then into this offering here, into this birthday gift. If you have any further questions, I think you can feel free to contact Admiral. And I hope that you enjoyed this webinar, and I hope that you will join the next webinar we'll have together, which will be then here on Friday again. So you can find all webinars on admiralmarkets.com and then education. If you click on this, you will find here those webinars which are taking place together with me. And this is the weekly market outlook here at 1 p.m. Central European summertime in this case, and I really look forward to it. So that's it from my end. All the best. Happy trading. Watch your stops. Enjoy the rest of Independence Day, and from tomorrow, be careful, because especially on Friday, volatility should come back, and if NFPs disappoint, I have the feeling not only the US dollar will see some pressure, selling pressure, but also probably equity markets will have some trouble to hold the current levels, but probably see some nosedives. And yeah, that's we wait for it. We wait for volatility. But now, have a nice evening. So all the best, and talk to you on Friday again. I look forward to it. See you, and bye-bye.